Okay, Professor Jim Schultz here from my Finance 513 students. I wanted to go ahead and lay down a YouTube video here for your Chapter 8 material. I wasn't originally going to do this, but then when the mid-course evaluations came back and you guys are really enjoying the short lectures I'm doing so far, I thought, hey, let me go ahead and piece one of these things together. And so I wanted to expand on the market indexes material that you guys read about in Chapter 8. I thought the text did a pretty decent job of kind of introducing you to the inner workings of some of the more popular indexes, not only in the United States, but even around the globe. And so I wanted to go ahead and expand on that and go into a little bit more detail on definitely the two most popular indexes in the United States, and maybe the two most popular indexes in the entire world, just because the United States economy is so important in the global framework of everything that each country is trying to do financially. So let's go ahead and get into this a little bit more. So we're going to talk about the Dow, and we're going to talk about the S&P 500. So the Dow Jones Industrial Average, or the Dow. This is a price-weighted index, and right now it has 30 stocks in it, and it has had 30 stocks in it for quite some time. Back in the late 1800s is kind of when the Dow got started, and when the Dow started off, it only had 12 stocks in it. And here's a little trivia note for you guys. There is only one stock, there's only one company that was in the original Dow that is still in the Dow. And that is General Electric, or GE. And so that's kind of interesting. They were in the original 12, and they're still in the Dow today as kind of a piece of history, I guess. The 30 stocks that are in the Dow today, we're going to talk about a couple of them here in a second. But what you need to understand is right now the Dow is approximately 17,000. That number is determined by a price weighting mechanism of the Dow, and we're not going to get into specifically the how the Dow itself is calculated. It's a little bit more complicated than the examples you guys worked on from Chapter 8 were really simple, and I really wanted you to just be introduced to the idea of price weighting versus market valuating. And depending on how the next couple of chapters go, and when I take a closer look at some of the material, I may add in some more complicated examples that would more closely mimic how the actual Dow is calculated, how the actual S&P is calculated, how the actual NASDAQ is calculated. But we'll have to see how the next when I take a closer look at your reading assignments and see kind of what's on your guys' plates, I'll make that decision at that time. But the basic idea of the Dow is still the same as what you saw in your homework, in your practice problems, and what you read about. It's a price weighting index, which basically means the relative size of each component does not even matter in the weighting of that component in the index. Basically, it's going to be whichever stock has the highest stock price is going to carry the most weight, and it's really that simple. And so when you look at the top components of the Dow, this is as of month end June 2014. So this is very recent. Visa is your highest price stock in the Dow. Visa is like $220, $225 a share, whatever it is, but it's a $200 stock. IBM is a $200 stock. Goldman Sachs is a $175 stock. And so you go on down the list. The highest price stock is going to carry the greatest weight in the Dow. Now, one of the biggest drawbacks of the Dow, and what a lot of people say is the biggest drawback is, let's back up a second. Many people, when they refer to the market, when they refer to the stock market, they are referring to the Dow. They are referring to what the Dow did in a given day. Like today, for example, I think the Dow went up like 67 points. And so a lot of people would say the market went up 67 points. And that's not that awful, but you're kind of missing the mark for a couple of reasons. Number one, the Dow only has 30 stocks in it. Now, the stocks that are in the Dow, like Visa, IBM, 3M, Chevron, Caterpillar, these stocks are massive. These are mammoth, blue chip companies that have been around for a really long time, and they make up a huge share of the marketplace. However, if you just look at there's 8 in this list. If you just look at this list, 4 out of the 8 are in the industrials sector, right? And if you went on down the list and looked at all 30, you would actually see that a high majority of the whole 30, I'm not sure what number it is exactly, 8, 9, 10, 11, but a big chunk of the Dow is industrial stocks. And so many people say that if you look at the Dow, you're not representing today's economy. You're not representing, today's economy that's so heavily invested in things like, electronic cars like Tesla, or social media like Twitter and LinkedIn and Facebook, right? I mean, take your pick, right? Or even just technology business today with like Amazon. Like a lot of people say they're missing the mark because these companies that are so representative of the global economy or the U.S. economy in 2014 are not represented in the Dow. And you know what? That's a fair point. I mean, hell, Apple's not even in the Dow, and Apple's been around forever. Apple's not in the Dow. And so people are like, man, the Dow really misses the mark. And you know what? That's a pretty good criticism. I think that's a fair criticism. The last point I want to make about the Dow has to do with this divisor that you saw in your homework problems. And I kept it's really simple in the homework problems. But the divisor is basically this. When the Dow got started back in the late 1800s, it had 12 stocks. It was literally, if I'm not mistaken, 12 divided by 12. And it had a value of 1 or something like that. Right? And so the divisor was very simple to start with. But then over time, what happens is stocks will have, these are just 2 examples, stocks will either split or they will spin off into other stocks. And that creates all kinds of problems for keeping the index value constant after that corporate action takes place. Like take a stock split, for example. Take Apple. Apple's a great example because Apple just had a stock split like a month ago? Apple had a 7-for-1 stock split. So Apple was at about $700 a share, and then they issued a 7-for-1 stock split. So what that meant was their stock price was going to become 1/7 of what it was. So its stock price fell to a little under $100. But in return, for every 1 share that you owned as an Apple shareholder, you now have 7. So you for every 1 share that I had, like I'm an Apple shareholder, and I got a notice in the mail that just said, hey, for every 1 share you now have 7 shares. And I said, okay, great. But at the end of the day, my portfolio value was literally unchanged. There is no value creation or destruction from a stock split. And so that is what this divisor is put in place to adjust for or account for. When these different splits and spin-offs take place, the divisor of the price-weighted index equation needs to be adjusted to account for that split or that spin-off. And just to give you some context, in 1928, the divisor was 16.67. In 2010, I tried to find out what it is today, and my Google searches were not really helping me. I'm sure if I would have spent another 30 seconds, I could have latched onto that info. But the most recent I could find is 2010. And that number is a fraction of 1. And so that divisor just keeps getting driven lower and lower and lower as stocks keep splitting and spinning off and so on and so forth. The S&P 500, is very, very different from the Dow for a couple of reasons. Number one, it's a market value weighted index. So what that means is the market value of a company, also known as its market cap, is found by taking its stock price and multiplying it by the number of shares outstanding. That is the most common way that the financial markets measure the size of a company. They don't typically measure the size of a company by the number of assets in the company. Instead, they will look at the market cap of the company. And so the S&P 500 is a market value weighted index. It's a size index. So it's going to have, so the other difference is it has more stocks. Whereas the Dow has 30, S&P has 500. These are going to be the 500 biggest companies in the United States. And so you get a much broader swath of the United States economy looking at the S&P 500 as opposed to looking at the Dow. In fact, 80 to 85% of all market activity that takes place in any given day is in these 500 companies. And so there are thousands and thousands of publicly traded companies in the United States alone. By only looking at these 500, you actually capture the majority, the lion's share of what happens in the stock market in any given day. The biggest company in the S&P right now is Apple. That's fairly recent. Exxon is number 2, and Exxon held the top spot for quite some time. But Apple is up, I don't know what, Apple's up 28% this year or something crazy. They just had their earnings call a few hours ago, actually, and it wasn't that great. So I'm really interested to see what's going to happen to the stock tomorrow. But in the after-hours market, it's kind of undecided. It moved around a bit, but investors couldn't decide what they wanted to do. I think Apple, I might mix them up, but they either beat on revenues and missed on earnings, or they missed on revenues and beat on earnings. I'll have to look back and check. But all that being said, Apple's had a terrific 2014. So with this recent run-up, Apple is now the biggest company in the United States at $570 billion with a B. That is $500 billion. Apple is worth $500 billion, and they have $168 billion in cash on their balance sheet as of today. That is present day. That is real time. That is ridiculous. That's a lot of money. The smallest company in the S&P 500, so number 500, barely hanging on to the list, is ticker symbol URBN, Urban Outfitters. So those of you that are kind of outdoorsy people and you're very active and you like to get out there, you probably know this company very well. I don't personally shop there too often, but my wife likes to shop there every once in a while. They're only worth just a little under $5 billion. And so that gives you kind of some context between the biggest company in the United States and the smallest company in the S&P 500 at just under $5 billion. Now, the S&P 500, by the way, right now is currently at just under 2,000. It's at about maybe 1985, 1987. We're actually going to look at it here in just a second. Well, we're going to look at kind of the S&P 500 and the Dow. Now, how often do these indexes change? Now, this is kind of interesting because there's actually no set schedule for either one of them. Basically, what happens is, the Dow and the S&P, they have these committees that basically oversee the indexes. And the committees basically decide when changes are going to be made in the indexes. Like, for example, a couple of years ago, I think this was a couple of years ago, or it might even be more recent than that, the Dow Jones committee people decided, hey, you know what? We don't want Bank of America in our index anymore. Because what they try to do, and here's the ultimate irony based, I hope you guys might hear the trio in the background. I apologize for that. But they probably saw a bunny through the window or something crazy. Anyway, hopefully they'll calm down. And so, a couple of months ago, yeah, hang on a second. Sorry about that break there. But my wife just got home and the dogs went crazy. So hopefully she can calm them down. But normally I would start the video over, but I'm beyond that point now. I'm not. There's no going back. And so, okay. Anyway, the changes in the indexes are somewhat arbitrary, and what that essentially means is you have these committees in place that decide what should be changed, what should be swapped out. With the S&P 500, it's kind of simple because it's based on size, so there's really no judgment factor involved there. And so basically, as companies get bigger and smaller, the index has to change to represent the 500 biggest companies in the United States. But let me pick up with the thought that I had with Bank of America. The ultimate irony with the Dow is the simple fact that the committee's goal is they want the Dow to be representative of today's economy, which I think is ironic because they don't have companies like Amazon or Twitter or Facebook or whatever, or even Apple, right? And so they kicked Bank of America out recently, and they brought in Goldman Sachs. They still wanted that financial exposure, and they felt like Goldman Sachs was a better representation of current economic whatever. And I thought that was kind of interesting. But up until just recently, Bank of America was in the Dow. Okay, so finally, here's the final thing I wanted to go through very quickly. Trading the indexes. So we're going to pull up a little Thinkorswim, which if you've had me before, you know this software intimately. If you have not had me before, then this is what you have to look forward to. And so we're going to talk about diamonds and spiders. Okay, so here is my Thinkorswim software, and so if you've never seen this before, don't get overwhelmed. I'll explain it all to you when our paths cross in Finance 512 one day. But if you have seen me before, you're obviously an expert at all these numbers, so I don't need to explain them. And so, okay, if you wanted to, you could actually invest in the Dow, or you could invest in the S&P 500. Now you can do it through index funds like through Vanguard, Fidelity, and stuff like that. But if you have a regular brokerage account where you're buying and selling stocks, you can actually do it that way too. And so the ticker symbol for the Dow Jones is DIA, which we're back, we're connected. Okay, is DIA, and so this is the options chain for the diamonds. The slang term for the Dow Jones ETF, this is an exchange traded fund. The slang term are the diamonds, and so with the ticker symbol DIA, and so the diamonds are currently selling for about 170, a little over 170. So when you hear somebody say, "Hey, I just bought diamonds at 170, I just bought diamonds at 168," they're most likely not referring to the actual physical asset diamonds. They're probably referring to the Dow Jones Industrial Average ETF. And so this is it, 170. And what's interesting about the prices of these ETFs is they're actually pretty simple. If you take the current index and you take approximately, let's see, that would be 1/100th of that index. So 1/100th of that index gives you the value of the diamonds, approximately. So the current value of the Dow is 17,000. The diamonds are trading for 170. Now you could also trade these spiders, which are the ticker symbol SPY. And again, I don't know why my connection is going in and out right now, but it doesn't really matter. The market's not really open. Currency markets are open, but the stock markets are not open. So the option chain may not populate because I'm having a difficult time with my connection. But the spiders are trading for 198. Now the price of the spiders are derived by about 1/10 of the current index value, and so that's why the current index value of the S&P 500 is about 1985, 1982, and so that's where you have the value of the SPY coming in right at about 198. So this is how you would trade or invest right through your brokerage account in the Dow or the S&P 500. And so that's a little bit about the market indexes. Again, I apologize for the for the commotion from from Teddy Crouton and company earlier, but we powered through, and I hope this was useful for you guys.